If you don't know who Bill Janeway is, you have never been to FiRe, and you're not reading very much. You should be reading more. It's a pleasure always to have Bill with us. And in fact, Bill has done something that I think nobody else has done here at FiRe, which is, and it's typical of him, he has methodically, over a period of about 5 years, created a body of conversations on risk and how risk is involved in everything from the global economy to the venture investing world and equity markets, which I think ultimately has been put together into a book. So I might start by asking you just a bit about promoting that book.
Absolutely.
And then, but the cool thing is, if you were here, you were living the song, and so we actually were with you, and I think you made an interesting statement that FiRe was part of the evolution of all this.
Absolutely, Mark. The conversations we've been having here over the years have contributed both to, the old line, how do I know what I mean till I hear what I say? So trying things out, trying ideas out that are perhaps not yet ready for primetime broadcasting, but for intelligent conversation on the one hand, and then reflecting back on the conversation and taking it the next step. And absolutely right, the whole discussions we've had about risk and uncertainty, about what can be measured and managed, and what in fact is just in the nature of the universe that we can't know, but we still have to protect ourselves. We talked about cash and control as the tools for hedging against the unknowable, enough cash to buy time to find out what the hell's going on, and enough control to change the parameters of the problem that have filled against you. And we certainly have talked about the dynamics of the innovation economy and how fundamentally dependent long-term, profound innovation is on sources of funding, upstream and downstream, that are not concerned with what the narrowly defined economic return on investment is. Right. They're concerned with national security, national development, conquering disease, the great missions of the public sector. And downstream, they're concerned with, if I buy this piece of paper, who can I sell it to who's going to pay more for it than I did? They're concerned with the return that comes from financial speculation. But in between, the big stuff from the railroads to the internet gets funded, and we have the chance to find out what it's good for, which was what we're still doing today.
Exactly. Do you want to mention the name of this book?
The book is called Doing Capitalism in the Innovation Economy. It'll be out from Cambridge University Press in October. It is now in the still somewhat extended process of production, but I'm delighted to say that I've got a great editor and some terrific support from you and a few others who know what I've been up to, and I'm looking forward to taking it on the road this autumn.
Cool. Very, very cool. Now, the last thing you said before I asked you about the book was kind of leading into a conversation that I know we both want to have. There's this little company called Facebook. I didn't buy. I don't know. Did you buy it? I didn't even try to buy, which is even different. So we're learning kind of day by day in the following days after the debacle, I think that's the right word, of this IPO, maybe what really happened or part of what really happened. But I'd be curious on your view, pre and post. I think you probably saw it from a more strategic perspective coming up to it, but I'm also curious about your thoughts, having read and heard what we think happened during that IPO. Does that have a secondary meaning?
Yeah, I think it is actually the significance of the Facebook IPO as it actually happened is strategic. If we roll things back, there is an enormous body of academic research, a very sound, disciplined academic research on venture capital returns. And one of the stylized facts confirmed by lots of research, and to which I, in fact, have contributed, is that venture capital returns are closely coupled to the performance of the public equity markets in general and very specifically to the state of the IPO market in particular. In other words, we and people running pension funds shouldn't think about venture capital as a separate special asset class. It's really the illiquid extension of the equity market.
Right.
So that's one. Two, since the bursting of the dot-com telecom bubble, the IPO market has been just about as much in retreat as it was when I was growing up in the industry in the 1970s. There have been very few IPOs. They almost entirely have been for companies that didn't need the money. Activity and speculative interest has been limited to this narrow social media group, where no doubt the sort of the Google paradigm of if we get enough people using our stuff, going on our website, we'll work out how to make money from them. It hasn't spilled over to create the kind of broad and vibrant environment in which speculative capital gets deployed widely and deeply enough so that the hopeful monsters, some of which turn into an Amazon or an eBay, others of which, sure, they turn into pets.com, or they always were pets.com, but that kind of environment. We've had two major efforts on the part of my brethren in the National Venture Capital Association to promote IPO bubbles. Nanotech failed, and we can talk about why. Clean tech has failed. So we have this narrow little area where there has been excitement. And
that being social media? Or?
Social media. And the clear overreaching, the understandable overreaching on the part of...
The necessary
Well, look, I remember back in 1983, I was very much involved with the first IPO for a venture-backed company whose market value at offering was $1 billion. First one ever. And the inside venture investors, when we were on the road show and the interest came pouring in and it was clear we had a hot deal, couldn't stand it. And they did exactly what the inside investors in Facebook just did. They increased the size of the deal and, in that case, went from selling no shares to selling a significant number of shares. And it's hard.
Was this BEA?
No. This was long before BEA. This was 1983.
Who was this?
Diasonics.
Okay.
You can look it up. And it's hard to criticize the investors who were behaving perfectly legally with full disclosure for taking advantage and behaving like rational economic actors.
What difference might be making real things with real revenues?
Yeah, understood. But you know, when Amazon, Google's IPO was a hot IPO at a very high price. It turned out to be justified. It may be the single best economic model anybody's ever come up with. It may be now challenged. It's so good that there is a process
But can't
of
we
reaction.
call that spurious? And that was an accident. That was really a happy accident where even the guys who were the founders didn't know they were going to make money that way.
Well, when they founded it, they didn't know it was going to make money. By the time they took it public, it was making a lot of money. It was valued at the money they were making was valued at a very high level.
Yeah.
But in fact, talking about Google, and I don't want to leave the Facebook. I think there was clearly, look, the market is telling you there was overreaching.
Right.
I wouldn't dream, having myself been sued by stockholder litigation so many times I can't count, and I must say, as the champ said, they never laid a glove on me. But I wouldn't dream of getting into discussion of who did what and who said what on the road show and whether the litigation that's begun is legitimate or it clearly is going to complicate people's lives for a while.
Right.
But from an economic and financial point of view, clearly the IPO overreached, and from a systemic point of view, it clearly is not likely, well, let's say this, it is not likely to regenerate a broad, vibrant IPO market. Right. The signal that was concerning going into it was when it was clear that there was an unusual amount of retail investment interest. And that is always a signal that you better be careful It goes away as fast as it comes. And so consequently, I'm concerned that that rather than reviving the IPO market, the Facebook IPO may have served to repress it, to double down on the repression of the IPO market, and that has consequences.
It's hard not
back
to doubt that.
upstream into the innovation economy. That's really the point I'm trying to make.
Yeah, I think you're totally right.
Yeah.
And it reminds me of the wake of the derivatives collapse, you know, and the anti-Wall Street feelings. It's kind of like, well, here we go. Did you get involved in that horrible IPO?
Yeah.
It's become street talk. People
That's
are going
right.
to say, I'm not going to do that
That's right.
again.
That's right. Now, in the meantime, you know, the venture capital so-called industry is continuing to consolidate. It's kind of bifurcating. There are a small number of very large firms, very large firms, a lot of very small firms that are intelligently, in my view, backing, you know, angel investors, funding early-stage startups, but with the expectation that they're not going to build sustained independent businesses. They're going to hold an auction at the earliest time and not take the risk and accept the dilution that goes with trying to build a real business over time. So I think that we're stuck there. And the Jobs Act, the best thing about it is the name. I mean, absolutely brilliant marketing, right?
That's good.
Reducing the cost of being a public company by reducing the extent of the regulatory oversight and the communications requirements on the companies is not going to reconstruct the ecosystem that had evolved from the late 70s through the 90s, which supported the channel to the public market for emerging growth companies. That all went away in the bubble when all the guys in the industry, Alex Brown, Hambrecht and Quist, Robertson Stevens, sold out to the big banks, who of course didn't know what they were doing. They were buying at the top and closed them down. That challenge and the lack of a business model for that kind of specialist investment banking firm isn't going to be changed by the Jobs Act.
I wonder if we're not seeing a very long-term trend, not just in private equity or in venture capital, but many things, banking in general, where we, for a while, we handed the car keys over to the guys who knew how to drive the truck or whatever, and they drove it into the wall a few times, and people finally said, you know what, there's got to be some other way. And now we're seeing this whole, really an explosion of ideas about, it almost goes back to the Dutch auction thing that you know, Google, but the whole idea of, and that Hambrecht in it, but the whole idea of, well, how can the people become their own due diligence instead of letting some guy at Goldman Sachs tell me one thing and sell it the other way? Yeah. And not that that's the right answer, but I think that the gatekeeper / due diligence jobs that were being done by venture capitalists and being done by investment banks in the past, probably we don't have the respect for those channels today in that world as we had 10 years ago. And so what I'm seeing is successful attempts to raise smaller amounts of money through the internet.
And clearly that was also one of the messages of the Jobs Act, was to make it easier to do that. Now, I think there are a couple of different issues here that can walk on each other and have to be separated out. First, for a category of startup, namely a web-oriented, consumer-oriented offering, some kind of service offering, the cost to get up and running is so small. When I'm lecturing around the universities, I like to tell the kids, you know, you don't even need your parents' credit card. You can do it on your own. And so for a category, the kind of crowdsourcing, a little bit of money, we'll try it a lot of different times, that's fine. And sure, out of that may come Zynga or whatever. I don't look on that as profound, deep innovation. On the other side, the opening up to, you know, creating a forum for amateur investors to fund profit-seeking entrepreneurs. I mean, we've seen this movie many, many, many times. That's why there is an SEC.
Tulips.
Yeah, that's why there is an SEC.
Yeah.
I mean, when I was a kid, when I came out of Cambridge and went to Wall Street in 1970, the IPO market was the wrong side of town. I mean, it was like you know, the Vancouver penny stock market. It was utterly unrespectable. It was for shooters and gamblers who couldn't find Nathan Detroit's floating crap game. And the people who served it, I mean, there was an IPO for Ford Motor Company in 1956, but by and large, it was not a respectable activity. And it took 10 years. It took the SEC doing a major study, driving the NASDAQ, creating NASDAQ. It was really done by the regulators to make pricing transparent, to bring the NASDAQ market under the same disclosure requirements as the big board. Mm-hmm. And over time, with the emergence of the new digital economy and the new companies that embodied it, from Tandem Computer through Apple, it not only became respectable, it became one of the great engines of growth.
Right.
We've kind of dismantled that and turning the market back to saying, well, we'll make it easier for the guys who can't find the floating crap game to come on the internet friction-free and toss their money around. It will. Some good things will be funded out of that. Mm-hmm. But you know, we had at a recent meeting where a bunch of us in the Valley were talking. One of them being a senior partner at a very distinguished Silicon Valley law firm, and I said, "What do you think the mean time to scandal is from the Jobs Act? 5 years? Less." That was the answer.
6 months. Yeah. It's not only that it's been dismantled, but I think that there's also this there's a retreat on the part of retail investors, clearly from the public markets, at a time when I think that they're feeling they can't possibly compete with Goldman Sachs or with the big banks.
I think that's right. I think that's fair.
And we look at investment money now. We look at the turnover per day and volume on Wall Street, and it's a huge slide in the pie away from retail and toward professional investment. This is complicated by things like the ability of Goldman and those with lots of clout to relocate and co-locate their servers nearer and nearer the actual NASDAQ or wherever they want to go, so that they have that actual microsecond of. And in fact, I was in a meeting last year in Germany where the CIO of the New York Stock Exchange was actively selling that advantage.
Right. The high-frequency trading phenomenon is, I will say again, I take it as a positive aspect of our current situation, and there aren't that many, that the SEC is kind of back in business under Mary Shapiro. Yeah. And they have recognized that this high-frequency trading, HFT, phenomenon bears a great deal of scrutiny. It's not only that it now accounts for more than 60% of the equity trading in the U.S., where the trades are driven by computer analysis of, when I say short term, we're talking microseconds, of discrepancies between statistical correlations among different securities. In other words, the trading has zero to do with anything about the fundamental economics of the businesses whose shares are being traded. It's not just that. It's also that to take advantage, some of these HFT specialists, and they're not the big banks. These tend to be specialist hedge funds. They put in 100 orders and jam the book, and then pull 90 of the orders at the last minute. Yeah. And this is all taking place in micro to milliseconds, blocking access to the exchange for some mere long-term equity investor like Fidelity. So part of the pressure on this is coming from the Fidelities of the world about the market getting polluted by people who are not only not interested in the economic fundamentals, but actually get rebates from the exchanges for bringing their volume, for being liquidity providers. So there's a whole set of very complex but important regulatory issues here.
In human being terms, it looks to me like cement. Yeah. It's kind of, if you take, there are two things that happen. It was bloodletting. It's kind of a vampiric experience where you're taking the juice out of the market, so that there, whether it's volatile or not, you're getting all the good stuff. But it's also kind of like cement, because you're in a market that would be moved based on what we would call true value. It's now being, all that movement is being second guessed by computers to the point where it changes the dynamic of the movement of those stocks.
Yeah, well, the market is driven by disagreement about fundamental value historically, because we don't know. We don't know what the net present value of the future cash flows
historically
are. Exactly. And people disagree about that, and that's what makes markets. And you're right, it gets diverted away when this correlation trading that is not concerned with that takes place. It doesn't mean that the market would automatically produce the efficient outcome.
Right.
The whole point is that it doesn't.
Right.
That's why there's room to make money in it.
Right.
The other thing, Paul, that you guys were talking about just now that I do think is very important here, and it plays into this whole question of where's the innovation economy now and where does it go? I think it was Mark, you said about how there is an aspect of intellectual property that needs to be shared. And I look back, both my own work and then reading George Dyson's wonderful book. Let me give him a plug, Turing's Cathedral, just published a few weeks ago. At the root of the digital electronic revolution, from semiconductors to software, were funders, creative funders and creative customers from the federal government who, at the most fundamental level, insisted on a loose intellectual property regime so that there were lots of spillovers. Mm-hmm. There were certainly the opportunity and the ability to capture and monetize a proprietary innovation. Otherwise, how would IBM have become IBM? But there are two great moments that George talks about, and when I think about where we are now, we should reflect on this. In 1945, John von Neumann wrote a paper about how to turn Turing's abstract machine into a working computer. Mm-hmm. And in 1964, Paul Barron wrote a paper for DARPA on how to design and implement a communications network that would survive an atomic war. Right. In each case, the people who paid for the research and the people who did the research had a very direct conversation. Do we classify this? Do we patent it? Or do we give it to the world? And in each case, they gave it to the world. Mm-hmm. As a result of which, by the time the Princeton computer, von Neumann's computer, was up and running in 1952, there were a dozen projects that were moving things along. And similarly, of course, we wouldn't have had the internet if it evolved the way it has evolved as the open environment for communications and transactions. If it hadn't been, if it had been kept as DARPANet, yeah, we'd have a very different economy today. Right. So I think recalling the role of the state as a constructive force, not the enemy, as a creative force in enabling for-profit, entrepreneurial, venture-style building of new businesses is just as important as recognizing that at the other end of the spectrum, in the public equity markets, there is a constructive, necessarily wasteful role mm-hmm. for financial speculation. Mm-hmm. But that requires oversight, responsiveness to excess, just as upstream, trying to have the government pick who's going to be the Google, yeah, instead of, as it did, fund the National Science Foundation, funded the work at Stanford by Larry Page and Sergey Brin mm-hmm. that produced the PageRank algorithm. Mm-hmm. So there's this balance of integrating. This is really where I'm going. There's an integration.
There's that word again.
There's this integration here, and it really, in a way, it's all that I've thought about and talked about with you and put into this book, of integrating between the political, the role of the state, the financial, the speculative bubble and crash dynamics that are inevitable mm-hmm. in liquid financial markets, and how between them and out of that interaction comes the great waves of innovation that over the last 250 years has moved us from the peasant penury of the 18th century to where at least we have the potential for billions of people to live above the poverty level, and even for some of us to live better than anybody else ever has in history.
Yeah. That was beautiful. Thank you. We have enough time for a couple of questions if you have questions, and we have microphones in the aisles. If not, I've got one more. There are two paths that are right in front of us. Yep. And I wish we had 20 minutes or an hour for each one. So let's try and do these quickly.
Sure.
Going back to the core idea of the new book, how does this innovation economy remain healthy with all the problems we just discussed?
It's a good question. First of all, there is, I'm not going to say there's nothing new, because there is a new aspect. It's more centralized. But the notion of the follower nations working to catch up by hook and by crook, goes back, as you and I have discussed, to Sam Slater stealing Arkwright's patents and putting a mill up in the Blackstone Valley north of Providence, backed by Moses Brown, and creating.
It goes back to the East India Company.
Absolutely.
Actually. Yeah, right.
And by the way, I always try to give people some reading to do. The least read great economist is a German called Friedrich List, who wrote a book called The National System of Political Economy in the 1850s. The New York Public Library's translation is dated 1883 into English. As a first-class scholar has said, he might as well have called it the National System of Innovation, because it has to do with how state protection for infant industries, the manner in which the impossible to accept risks of competing with the leading nation, U.S. against Britain, Germany against Britain, Japan against the U.S., only takes place with the support of non-economic guarantees. Right. So I think there's a trade here between recognizing a certain kind of legitimacy at the same time as saying up to a point. And you can't leave it to the private sector to protect itself from state actors, maybe even not at the ExxonMobil level.
Right. No, absolutely true.
So I think this balance here is critical.
Yeah, okay. The other path I wanted to follow, and our 1 minute left, I want to go further down this track of where you see the future on the equities markets regulatory story. Are we going to see a resurgence in retail participation in the equity markets, or is that over for a couple of generations? How does this work?
Well, I think we're still living through the consequences of 2008. We're not maybe even halfway through. And the way I like to put it is that, contrary to Ken Rogoff and Carmen Reinhart, this time it was different. And this time it was different because, as Chaim Minsky recognized 25 years ago, what we've experienced is the first global financial crisis of big state capitalism. This time, the governments of the developed world, unlike the 30s, when they were less than 10% of the national economy, were big enough to save the financial system, the excessive financial system, from its own excess in order to protect the market economy. So we only wound up in the core countries with 8 to 10% unemployment instead of 25 to 30%. Right. Having said that, working through the regulatory response to those excesses is still a long-term game. I do expect that there will be more regulatory oversight, particularly given what happened at J.P. Morgan and what happened at Facebook. I do not expect to see salvation from the retail investor. I think we're in what we used to call in Wall Street, we're in the mode of an earn-out, which is better than a liquidation, but it is slow and painful, and it doesn't come with a lot of exuberance.
Right. Thank you very much.